Oh, nasty hit piece out from the Federal Reserve in the Financial Stability Report about real estate. Let's talk about that Financial Stability Report. Let's talk about what Bank of America just said about the housing market. And holy smokes, what we talked about just a couple weeks ago is actually starting to happen in the housing market. Now, look, we know about like 4% of the audience, small tiny group, has the notification bell on that is also a hater. So haters plus notification bell on, about 4%. And the cool thing about those haters is even they know that Kevin loves real estate so much, and knock on wood, so far been pretty dang accurate about the real estate market peaking in Q1 and Q2, and that's exactly what's happened. And so far, exactly what we see in the trends continues to take hold. Let me go ahead and explain exactly what I mean by showing you what we talked about just even 2 weeks ago and how that's already changing the markets. Then let's get into that Fed stability report. Here we go. Look, you know I sold most of my real estate in Q1 and Q2. I sold 85%, over 20 different properties in SoCal because we saw these price drops coming. And what have we just recently seen? Well, we saw this flattening. We saw this flattening right here in the number of price drops happening nationally because this is when we had a trough of interest rates. That is, interest rates, like you could see this on the 10-year Treasury charts, they stopped rising as much going into August. So August, as evidenced not only by this chart, but by Pulte Homes, actually saw a pretty decent resurgence in real estate and real estate pricing, showing you how sensitive real estate is. That if rates just stop going up, we could see some stability come to the real estate market and maybe prices will just stop falling, which would be nice and would be a sign that, all right, soon it's going to be time to start buying, especially when those rates come down. And hopefully by then those prices are at a lower level where it's more affordable for all of us to buy. Although valuations are still pretty high, as we'll see from what the Federal Reserve has to say in just a moment. So we've surmised that because of this trough, likely turning into a higher level of price drops following the 10-year Treasury moving up, we surmised that price drops would lead to lower sales prices after this little trough here. And that's exactly what happened. Not only did we see those price drops come in, but take a look at actual median closed sale prices in different areas. So this is across the entire country. You can kind of see the little flattening that we saw over here, and now we're going even lower. Across the entire country, now down 8% from the peak of real estate pricing. Look at Seattle. You saw the pause. Now we're dropping lower, 11.5%. What are we seeing in Austin, Texas? You see the pause roughly over here. You see the peak over here. Now we're down 16%. Down 3.8% in Tampa. So as we saw from the Case-Shiller report, Tampa and parts of Florida are actually holding up quite well. It's a lot of the westerly markets with some other markets that are getting hit a lot harder, like Seattle down 10.5%, Denver down 7%, Vegas down 9.6%, LA, San Diego, and San Francisco down 11% from their peak. Kind of wild moves in pricing here. Quite substantially wild. And what does Bank of America remind us of? Well, Bank of America suggests this is starting to look a whole like the bubble popping in 2008 and 2010. Take a look at the green here. At a reading of 79.5, the seasonally adjusted index, the index that they're referring to for data here regarding home sales, is at April 2020 lows and back to the levels following the bursting of the housing bubble in 2008 and 2010, likely because mortgage rates are now above 10%. Less people are wanting to sell, only the people who have to sell are selling, or you get some investors that are dumping, be it REITs, pension funds, or just individual rental homeowners who were speculating on an Airbnb or whatever. And Bank of America here warns in purple that housing activity is likely to retrench even further going into the year end. So you've got definitely some pain here in real estate, but what's this financial stability report? And what is the Fed telling us about housing? Well, in general, Jerome Powell in his last press conference told us that housing is clearly seeing a sharp deceleration. And in some areas, we're seeing price drops. And the reality is in many areas, we're already seeing actual closing prices come down. But we've clearly seen a U-turn. So what does that mean for valuations and stability? Well, let's go to the financial stability report, which just came out. Oh, before we hit that, quick note, Moomoo offers countless amazing trading features to help you take your trading game to the next level. So for US users, use the link down below and get up to 15 totally free stocks, each valued up to $2,000 when you sign up and make a deposit via Moomoo. On top of that, Moomoo is giving out a special add-on of $10 cash back on top of this benefit for new users to reward and celebrate the company's 10-year anniversary. So use my link down below, get those deals, and Moomoo is now also available for you in Australia. So if you're part of the Australian audience, check out those links. Terms and conditions, of course, may apply. Financial Stability Report says, although housing activity weakened and national average price increases slowed, that would be year over year, right? Year over year, you can have price increases, but then month over month, you can have these sort of decreases, right? You have that inflection point down. Home prices are still, even after these price drops that we've seen, they are still historically high relative to rents. That's not good. And it's not just home prices, it's commercial real estate and farmland as well, as we'll see in another slide here. Household debt, however, remained at modest levels relative to GDP, and most of that debt is owned by households with strong credit histories and considerable home equity. So even though we have a lot of pain in real estate because of high rates, and yes, we have low supply to offset that, the big thing that makes this time different, dangerous words, but true, from now to 2008 is we don't have the reckless lending standards that we had in 2008. So we're really not expecting a crazy kind of foreclosure crisis, and real estate could actually U-turn relatively quickly if we see interest rates plummet quickly, if let's say we started actually seeing inflation come down overall. That is the big priority. We don't actually need jobs to go down if we could get inflation to go down, right? That's the big priority. Just get inflation down. Now, regarding valuation pressures on real estate, national average home prices continue to rise year over year, although recent data showed a significant slowdown in growth and falling prices in some geos. While valuations are at high levels, home prices could be particularly sensitive to shocks, and commercial real estate continued to increase since the last stability report in May, albeit at a slower price. At the same time, we're starting to see valuation pressures for commercial real estate also move higher, especially since in commercial real estate, you're much more likely to see a lot of those adjustable rate mortgages, whether it's in multifamily commercial or in office or whatever, come due for a refinance, forcing some to sell. You have less of this issue in the residential space where most of your mortgages are fully amortized, which means they're fully paid off at the end of the loan. There's no big balloon payment, and they're either 15 or 30-year terms, so you've got a long duration on these. Now, the Federal Reserve does mention that house prices have decelerated sharply, but valuation prices remain, or valuations remain high. And the way they look at that is they basically look at two different forms of rent. They look at home prices relative to owner's equivalent rents, and they look at home prices relative to current market rents. Owner's equivalent rents are deemed to be lower than actual market rents, but the Fed here says that by both metrics, house prices are elevated to levels that we haven't seen since the mid-2000s peak. That's a very scary reference. So they're really comparing us via this chart right here. Look at this. Stretched house price valuations, which we did not see all the way up to the pandemic. We did not see that. So for the 10 years prior to the pandemic, even though it felt like housing was expensive, it was nowhere near as expensive relative to rents as it is now. The only time it's been this expensive before is right before the 2008 bubble. That is scary because it really sends the signal that, wow, we could be in for years of a correction unless, of course, those mortgage rates come down very quickly and put a floor under this market in some ways that housing inventory shortages already have as well. In addition to that, rising borrowing costs is definitely going to put pressure on households and businesses, especially those with adjustable rate mortgages. And an economic downturn or correction in real estate prices would also put pressure on businesses and household balance sheets, really suggesting that, hey, like we get a downturn in real estate, you're going to put pressure on households and businesses, but households and businesses have really strong credit and low credit or debt risk. What are they saying with that? Let me translate that. And I think the easiest way to translate that is just go over here. What they're really saying is we need to slow the economy. And an easy way to slow the economy is slow real estate. If you slow real estate, per Robert Schiller actually, and his research over at Princeton, you have the largest wealth effect, which means for every dollar of net worth you lose in real estate, you're incentivized to generally spend $1.50 to $2 less. For every buck you lose in net worth in stocks, that correlation is a lot less clear. Maybe you spend $1 less, but it's not as amplified as what you see in real estate. In real estate, it's where you see the real slowing of the wealth effect. And since credit is strong here, it actually makes sense for this Fed to say, look, we need to slow the economy. Let's just kill real estate. Because if you selectively kill real estate, you're going to have the largest wealth effect, and you'll have the biggest impact on people stopping spending money, and that'll kill inflation. So it's no surprise that the Federal Reserve, Jerome Powell, literally said, if I were a first-time homebuyer right now, I would wait for a bit of a reset, when prices come back in line and supply and demand are back in balance. He basically bluntly told us, wait for prices to come down and then wait for rates to come back down. It's a great thing if you're looking to buy. It sucks if you're an owner, but we're going to be going shopping with HouseHack. It's great. It's for accredited investors. If you're not accredited yet, I think we're only about 3 months away, which is exciting from accepting non-accredited investors. The cool thing is we're working really hard on expanding our accommodations platform because we see a really big opportunity in midterm accommodations. So not necessarily like one day in and out, right? But that 2-week to maybe 16-week customer, like that business traveler customer who wants a house and not a hotel, that area yielding substantially higher rents for the flexibility, and there's little competition. According to Airbnb's earnings call, only 10% of Airbnbs are actually professionally managed. That is low-hanging fruit to professionally compete against. Well, there you have it. Thanks so much for watching. Good luck out there with the housing market. Pain is here. Pain's likely to continue, and if you go ahead and jump on over to the 10-year mortgage rate right now to get a little bit of a preview as to potentially what's to come on some of these charts, let's just put it this way. It hasn't relaxed any, okay? Look, this is the 10-year right now. It's at 4.163, now decently over 4%. Notice we did trough over here and we fell back under 4%, but we just couldn't last under 4%. Sorry, that's the last peak there. There we go. We troughed down to 3.93 and shot right back up to basically highs where we were just the 3rd week of October. Quite remarkable. Anyway, thanks again for watching. We'll see you in the next one. Goodbye and good luck.